Hello and welcome to the Passion Driven Pioneers interview series. I'm your host, John Channon, and today I'm joined by Mark Donahoe, who is the co-founder and owner of Monitor Finance. Mark, thank you so much for joining us today.
Sure, my pleasure.
Would you like to kick us off with a brief background as to who you are, what you do, and then the business that you're in?
Yeah, so as you said, my name is Mark Donahoe. I graduated from the University of St. Thomas in 1983 and had a degree in finance and econ. Um, my first job and really my only corporate job of almost 25 years was at Piper Jaffray. I started there in late 1982, left in August of '06. So had a great career there. Moved up from first couple of years starting out in the guts of the business, which was what they called the operations of the business, and then got a chance to come up. I wanted to be in production. Got a chance to come up and take a position on the trading desk, and then kind of worked my way up from there. So the last 5 years I was there, I ran all of the institutional trading businesses, which comprised all the New York Stock Exchange, NASDAQ trading businesses. I ran all the regulatory and compliance businesses around these businesses, as well as ran the trading, the convertible trading desk, and a little bit of the risk arbitrage. So that was a pretty good foundation, in the financial industry. And then for many, many reasons, left that business in August of '06 and started Monitor Finance with three former Piper Jaffray associates that I worked with. And, over that period of time from '06 to now, we were solely focused on multifamily. And so we now own and manage 7,000 apartment units in the Midwest, which comprises Iowa, Nebraska, North and South Dakota, and Missouri. So that just gives you a quick overview of kind of where I've been in the last 40 years.
So, what was the initial spark that caused you to want to leave what you were doing with Piper Jaffray and actually start up your own business?
Yeah, so there's lots of things. The main driver was Piper had sold late '04, actually even into '05. Actually, it was in '06. I apologize. They had sold half of the company to UBS for a big number, and UBS was going to come in and make some changes. They actually sold the retail business, which I I ran the trading part of it, and I ran the compliance part of that, and the regulatory part of that. Um, and they were gonna make some changes to that, which is fine. It really wouldn't have affected me, but it was a really good opportunity for me to leave. I had been thinking about leaving the business. I was on the road all the time. I mean, I was on airplanes. Got to a point where I averaged over the last 5 years there of 200,000 air miles a year, which is a lot. and I still had young kids at home, and it was a great opportunity for me to leave on great terms and start this business with these other three guys. So that's what really precipitated it, was sort of a change in the overall corporate side of things. And yeah, I mean, there's other little things, but I think that would be the main driver of it.
And so, why go into business for yourself, though, versus kind of going to work for somebody else again?
Yeah, well, I thought about that because when I did leave, I had a number of offers, and I just decided, you sit 25 years in front of a trading terminal, and your life is really dictated by that business. I mean, you eat, sleep, and drink that. I was up at 4 o'clock in the morning, getting into the office by 6 a.m., and there are lots of nights I wasn't out of there till 7 or 8 o'clock at night, and many nights where I would hop on an airplane and fly to New York and wouldn't get in there till 10 o'clock for meetings the next day, and then back and forth and kind of all over the place. So it 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 made a lot of sense at the time to make that move from a lifestyle perspective, Financially, I was fine. So I felt it was the right time, and it felt like the right time. There were other times in there that, I'm like, do I want to do this or not? But this really lined up well for what we wanted to do.
So talk to us a little bit about what those first few years were like when you were starting this up in 2006.
Sure. So I had a lot of people say to me, you're going from, the equity business in the stock market to the real estate business. That's quite the transition. And I said, well, not really. When you look at the valuation parameters that you value everything off of versus equity versus real estate, they're not really that dissimilar. I mean, in the equity market, you look at a price earnings ratio, you look at a price to sales ratio, and that's sort of how you value things: cheap, relatively, expensive, whatever. When you get into the real estate, it's somewhat the same, but you're just looking at a capitalization rate, you're looking at balance sheets and income statements, NOI. It just made a lot of sense. It really made a lot of sense. And the other thing that I felt like we would have a nice advantage on was, when you're in the equity business, you really focus on the credit markets. And people go, why would you do that? Because the credit markets are always leading indicators, always. And you got more information from the credit markets than you did from the equity markets. So we had a fair amount of experience in that. And I do think when we went into the business in late 06, it helped us, especially through that financial crisis. So, but the first couple of years, we kind of jumped right in. It was a little bit of baptism by fire. We knew that we could raise equity for this. I had a number of clients over the years of my tenure with Piper Jaffray that were very interested in what I was doing. And some of my partners the same way. So for us to go into the business, it wasn't like, well, how are we going to raise money? We knew how we would raise the money to do these deals. And then how are we going to finance it? Well, that wasn't difficult because we did have a lot of credit market experience and debt experience. So for us, I think it was just a matter of getting our feet wet. And really, in the initial couple of years, it takes a while for brokers to really understand you and trust you. And when I say trust you, is broker comes to you with a deal and you go through the whole process with it. And then you decide that, you can't close the deal, or, you're going to retrade the deal for a lower price. They don't like that. I mean, and we don't like doing that. And we've never done that. And so I think after the first couple of years, we had bought probably 1,500 units in the first couple of years. And I think they realized that we were real and that we were serious and we knew what we were doing. And so I think from that standpoint, that first couple of years, didn't go along without any hiccups, that's for sure. But, we just looked at the valuations of kind of the assets, and, we said, this is a really reasonable price, and the cash flow was good, and we knew our investors would be interested. So that's kind of how the first couple of years started and went forward. And then, going forward after that, it just got easier and easier.
And from the beginning, did you always know that that was the market you were going to focus on, the multifamily apartment units?
Yeah, it was, because I didn't know much about anything about the industrial market or the office space or retail. I had owned a private real estate portfolio of rental properties that I had to this, off to the side. They weren't nothing huge or anything like that. But so I had a good feeling of what I wanted to do. And I think for us, it made all the sense in the world because it paid a cash current. All of our investors are high net worth investors. We don't have any institutional investors. That's by design. And most of our assets are legacy assets. These are investors that want to stay involved in this process. It's not a quick 3 to 5 year buy it and sell it kind of thing. So we position this as legacy assets, and like I said, most of our investors that's what they want.
Okay.
So
I'm going to pivot a little bit and
sure.
talk a little bit about innovation, right? So what are
Yeah.
some strategies that you're using to remain innovative in the space that you're in and in your business?
Yeah. So when we first came into the business, there were lots of things that we thought we could do, and we did do. We the first market that we attacked was the Des Moines market, in particular in the West Des Moines market. We did some research on it. It was, we found that it was a very highly fragmented market. It was very mom and pop oriented. And so there was quite a bit of product out there that, we were able to kind of take advantage of buying and then rolling up into that area. So those were our first big acquisitions, were in Des Moines, in that West Des Moines area, and we still today own everything. So I think from that perspective, that helped us, kind of jump into that, as there, and then it kind of gave us a little bit of a footprint as to where we wanted to go next, and we knew we wanted to get into Nebraska, and and then from there we kind of dovetailed into Missouri, and then the Dakotas later on.
Great. Good. Um, Maybe let's talk a little bit about the future. Can you offer
Yeah.
us maybe a glimpse into the future plans and goals that you have for your business?
Well, I mean, as I said, we're at 7,000 units. We have not made any acquisitions since August of 2020, and there's good reason for that. The asset class got incredibly stretched in valuation. It was just ridiculously overvalued. Saw a lot of syndicators out there running around with 3 and 5 year pro formas with crazy numbers attached to them. And so we just haven't been able to find anything that fits our criteria and our model. And so we really haven't done anything in the last 4 years. We do believe there'll be an opportunity here, probably second half of 25 into 26, where we believe that some of the stuff that was purchased in late 2021, even in early 22, with variable debt, the chickens are going to come home to roost on that very soon. And some of them already have, but I've my understanding, and just talking to some brokers and actually some bankers, is that there is a lot of extending going on in the marketplace with some of this product. But that can only go on so long. And then at some point in time, the banks are going to, say, hey, look, we either got to, we got to do something here. You got to put more equity in, or else, what are we going to do here? So I think at some point we'll see some of that product. We did see that kind of product during the financial crisis, which is very different to the situation that we're in now. But eventually we'll see that product. But the goal would be to add another at least 3,000 units or more. I mean, we're not done acquiring. We have a nice model. We have a nice property management company. We have a very good business there. We have just under $100 million of top line revenue, rental revenue. And so, we support a pretty good sized business there. We have, in the property management side, probably have a little over 105 to 110 employees, which includes all the leasing managers and maintenance staff and corporate and that kind of thing. So that would be the goal. But again, it's going to be dependent on, market and kind of valuations and things like that.
No, that's actually really good insights, and I appreciate your sharing that with the
Sure.
audience.
Yep.
So, knowing that this show, right, is going to be targeted towards people that are going to be maybe thinking about starting a business, or maybe in their
Sure.
first few years of business,
Yep.
do you have any final thoughts or words of advice you'd like to share with our audience today?
Yeah, I mean, I think it's a business that if you're just going to go into it kind of cold without a financial background, it's going to be tough. I mean, there are certain things, that lenders look at. To give you an idea, all the lenders that we use are just GSEs, or what we call government sponsored entities: Fannie Mae, Freddie Mac, and HUD. And they require, a balance sheet by each partner. They want to see your financials. So you can go into this as small on your own, starting out with like a duplex or ones and twos, and you're going to get bank debt. Um, and that'd be tough right now because bank debt's pretty expensive right now. It's just a matter of finding the right property and making sure it works from a cash flow standpoint. I would never, the way we look at things, we know there's purchases going on out there right now, assuming that so there's been an influx in supply, obviously, over the last couple of years, right? Huge amount of product built, but you've seen all that going forward being scuttled. So there's a lot of inventory to work through right now. But by the feeling is by middle of 26 into early 27 that we're going to be in the same situation we were in with COVID, which was we had a massive shortage of apartments and you had some significant move up in rent, that kind of thing. And so I think you're seeing acquisitions being made right now with that future in the next year and a half to 2 years on the come. And I think right now, when you look at trying to buy something right now, it just doesn't work on the debt to cap ratio. But there's a lot of people that are willing to look 2 years out and say, okay, this is where we think things are going. We think we can improve the cash flow over time and go from there. We're not willing to do that. We want present day. And, like I said, that's how we've done the business the whole time. And we can change, but right now we just still think things are stretched. And I personally think there's a lot of people that believe that rates over the next year and a half are going to be significantly lower. I don't believe that's the case at all. And I would not be surprised to see the 10-year treasury, which is where everything is priced off of in our business, at 5% in the next 6 months to a year. When we started in this business, just when we started in 06, the 10-year treasury was 5%. And the spread was about 100 basis points. So we did most of our deals at 6%, and it worked all day long because valuations were reflected. Valuations have not reflected yet, given where the rates are. So anyway, I would start slow. I would make sure I understand every component of the business, which means you're going to have to understand a balance sheet and an income statement, and understand sort of the workings of that, understanding what an NOI is, net operating income, and the valuations that people look at, cap rates based off of the NOI, and then kind of get an idea where your cash flow works and where it doesn't work.
That's really good. So listen, thank you so much for your time today,
Sure.
Mark.
Yeah, you're welcome.
Yeah, it was great hearing this story, and I haven't had anyone like you on my podcast before, so this is a kind of a unique market for us to hear about and learn about. And
Sure.
then to everyone watching, I look forward to seeing you in our next episode.